Hi, I'm Steve LaFrance with Blakely Financial, and this will be my final market update before we welcome a new year and present the year-end summary. So let's take a look at how November wrapped up and set the stage for December. The U.S. election results helped fuel November's stock market rally as investors focused on the incoming administration's policy agenda and its implications. The S&P returned 6%, but underperformed the Russell 2000's 11.1% return. All 11 sectors traded higher, with consumer discretionary and financials gaining more than 10%. In contrast, defensive sectors such as healthcare, utilities, and consumer staples underperformed. On a year-to-date basis, the S&P has returned 27%, recently trading above the key 6,000 level and setting a new all-time high. Smaller companies took center stage during the broad market rally, with the Russell 2000 surging 11.1% to set its own record high. International and emerging markets traded lower for a second consecutive month. And this trend of the outperformance of the U.S. markets, the U.S. economy, and the U.S. dollar has been the positive byproduct of how well we've handled our post-pandemic recovery relative to the rest of the world. The net result has been a substantial boost in U.S. productivity, which we're still continuing to benefit from. On the fixed income side of the markets, investment-grade bonds produced a 1.8% total return, bringing its year-to-date returns to 3.5%. Going forward, investors are monitoring two key areas: tax policy and trade. The administration is expected to focus on extending the tax cuts passed during President Trump's first term. This could stimulate economic growth and boost corporate profits, although it could also widen the fiscal deficit. On trade, the administration plans to use tariffs to advance U.S. interest in international affairs and renegotiate trade deals. However, in the near term, tariffs could also disrupt supply chains and slow economic growth and squeeze profit margins. Other critical policies include immigration and deregulation. There are concerns that tariffs, stricter immigration policies, and expansionary fiscal policy could combine to keep inflation high. And if so, the Federal Reserve might maintain interest rates higher for longer. Just after last month's update, they did cut by another quarter point as inflation remained in the low to mid 2% range and unemployment remained close to 4%. Elsewhere, there is an expectation that deregulation could create new growth opportunities in the financial and energy sectors, while relaxed antitrust enforcement could lead to more mergers and acquisitions. Economic growth and corporate earnings will remain important long-term drivers. But in the short term, we just experienced record levels of Thanksgiving air travel of 20.4 million passengers, Black Friday online spending of $10.8 billion, and Cyber Monday shopping of $13.3 billion. So it's clear that our strong economy and markets are maintaining momentum. That's all for now. Stay the course, take care of yourselves, and thanks for your trust and confidence.